Hi everyone, we are in London today to meet with William Jackson. He is the chairman of Bridgepoint's group board. He is also the co-chair of the Bridgepoint Europe Investment Committee. Altaroc made an €80 million commitment to Bridgepoint for our 2022 vintage. Louis Flamand, our chief investment officer, is meeting with William Jackson. Let's join them.
Hi William, thank you for taking the time to meet with us today.
Pleasure to be with you, Louis.
We've known each other for a few years, as the institution I represented before joining Altaroc was a long-standing investor with Bridgepoint. I'm really happy to meet with you today. Could you please introduce yourself and share with us the key milestones of your successful professional career?
Oh, well, listen, it's a pleasure to be with you, and great that you're with Altaroc, with Maurice. You know, we've worked together for many years, both of us. I was fortunate to join the private equity industry really at the beginning. I wouldn't claim to be a grandfather of the private equity industry like Maurice is in France, but I started my career 30-something years ago. When Bridgepoint was part of a bank, and I was a founder of Bridgepoint and have been chief executive for the last 20 years, and today I'm chairman of the firm and chairman of the investment committee. So interesting roles in a world that changes dramatically the whole time.
What is your role today at Bridgepoint?
I'm chairman of the group, of the Bridgepoint group. I'm chairman of the B investment committee, where Altaroc has its investment, and I spend my time primarily looking at new investment activity, working with our CIO on what our strategy is, but also every now and then talking to investors, which is always a great pleasure.
Could you please introduce your firm, Bridgepoint, and its history to us?
Yeah, so Bridgepoint is one of the leading mid-market in private equity investors in the world. Mid-market for us, because it means a lot of things to different people, is we invest in companies and support companies valued typically up to about €1 billion enterprise value, €1 billion enterprise value. And we do that through a network of offices around Europe. Everything we do has a European focus. And our kind of USP is total immersion in this space. So what we're trying to do is we have a significant team of people, very experienced team, very nice age range as well, because you need in these days to have people who are alert to the latest changes in digital technology and so on, but also depth of experience, people have been weathered by cycles. And a lot of local insight and expertise in Europe, so we know this space extremely well. And the organisation has a sector focus, so we focus primarily on 3 key areas. So business services, advanced industrials, and healthcare. So slightly different to some of the funds that you would see, and that represents about 70% of our activity. Clearly, we're most importantly focused on making returns, and so yes, we will do some things outside that area if we find the right opportunities, but that's where the core of what we do is.
As the private equity industry is getting more and more competitive, historical leaders of our asset class have had to reinvent themselves to remain successful. And several of them have failed to do so. I think that the evolution of your private equity business is actually a great case study of a successful modernization. Could you please talk about the modernization of your investment strategy, of your organization, with a focus maybe on the key initiatives you took after the global financial crisis?
Well, I don't think this industry is any different to any of the industries we commit our capital to. And the most important thing is to recognise that it changes and it evolves the whole time. And obviously, private equity and investing is very linked to cycles. But what you've seen in the private markets is just the level of sophistication that has come into the asset class over the last 20 years, not just in investment thematic, but in the way you can drive and create value. So Bridgepoint is very much a hands-on investor. Every company we invest in, we normally have a controlling stake. And we have a clear investment thematic. And I think the distinction between pre and post global financial crisis in 2008 is a really material one, Lou, because you go back to pre-financial crisis. Europe and indeed a lot of the world have been on a very long run of steady economic growth, and you could make good returns really in any sector.
Yeah.
And provided you were a smart investor, you had the capacity to buy number 4, number 5 in an industry. And I think at that point, people had to adapt their platform, and if you didn't adapt, you probably didn't survive. And that was much more pronounced in Europe than it was in the United States, although some big firms in the United States aren't around today. That, you know, if you think of names like Hicks, Muse, Tate and First, which was in the first part of this century a major player, isn't here today. But if you look in Europe, some really major names like Candover, Doughty Hanson, you know, 3i is a very different organisation to the one that it was, and you can go on. So we came through the GFC in pretty good shape, but you can either go through that experience and go, well, we were clever, we came out the other side, or you go, oh heck, you know, what's happened to our industry and what are the lessons that you can learn? And we spent a lot of time reflecting on lessons for the industry, and a few things came out of that. I think firstly, that to make money in the second decade of the century, you really had to narrow down your sector focus and develop expertise so that you had better knowledge than other people. I think secondly that investment conviction on that thematic is really, really important. And so long-term origination of opportunities becomes very, very important. So, you know, why do you really want to buy a company or invest in a company? What do you want to do with it when you've done that? What are the opportunities in our space, where pretty much all of our businesses are growth companies? What are the levers that you can pull to drive growth? Can you take it internationally? Can you regionalize it? Can you go from a regional business to a global business, etc.? And then, you know, how do you improve margins, systems, all of those things? And what kind of resources do you need to do that? And we spent a lot of time looking at our investment processes as well. You know, what were the lessons learned for the things that didn't go quite as well? Where were we committing capital across Europe, and what were the returns that we were getting from the different regions? Were there lessons from that? And one of the things that we've done more recently is really use our data to drive our thinking. Now, I don't believe that this industry will become, you know, AI is going to take over this industry, and you want an investment committee where the computer says you should commit the capital to this or not. But we have such a powerful database of historic investment decisions that you can look at it and you can say, well, if we're going into this space, what have all the other companies we've invested in done in this space? What have their margins done? How quickly have they grown? What are the what's happened to valuation multiples over 20, 30 years? And therefore have alongside you some scientific basis to look at your objective investment decisions as well. So lots of things, but I genuinely believe that in this space, you just have to keep reinventing what you do and thinking about how you do it. You have to have what I describe as constructive anxiety, because you know, you have to be anxious about what you're doing, thinking the whole time about how you do it better, but in a constructive way. And if you become complacent and you think you know everything, it's very, very dangerous.
What's been the long-term performance of your flagship buyout strategy?
So since the GFC, we try and create funds. We invest a lot of our own money in our funds, so we have good alignment with our LPs. And what we're trying to do, I think one of the learnings from the crisis is that, from that GFC crisis, is vintage year discipline. Trying to pick the macro, understand the macro in a private equity strategy, in a sort of this is a better year than another year to invest, I think is a mug's game.
Yes.
So what we try and do is build portfolios where we commit broadly the same amount of capital to every vintage year, have this investment thematic. And since GFC, we've been running at a 20% net return, and that's the target. Now, clearly, in this environment, interest rates will impact that up and down. But I'm confident that the features you have of private equity should result in long-term outperformance. And then it's all relative as to what stock markets do, and I think some people see private equity as a black box. It really isn't. In my mind, you have some features of private equity which you don't get in quoted markets. In quoted markets, you get pure liquidity, so you can come in and out, but you don't have great information because companies aren't allowed to share their forecasts, certainly in Europe with the market. Whereas in private equity, you have the opportunity to diligence a business like you do with your GPs. You have the ability to diligence a business with detail before you invest. You have control, direct shareholder, hyperlinked shareholder control on the type of actions you need to take. You're not trying to manage it to a quarterly set of numbers. You can time your exit perfectly, and you're selling 100% of the company, not one share or 1,000 shares or whatever. And so with those competitive advantages, you absolutely should beat public markets. But of course the balance is you don't have liquidity in the same way, and that's the trade. But so I'm very confident that through these times, having private equity alongside quoted is very powerful. And you actually, one is not a substitute for the other. You need both. But private equity should outperform and will outperform, but your cost is liquidity.
Who are the typical investors at Bridgepoint, and what is their average commitment?
So, it's an interesting area because it's changed significantly over time. So, when I joined the firm, we were originally set up as a bank parent, and we became independent 23, 24 years ago. And up until 2000, all of our capital came from the bank. And that was powerful for us because it enabled us to expand and develop this tremendous investment platform we got with a wealthy parent. And we're very grateful for that. Today, I guess 20 years ago, the majority of our investors were US investors, simply because 20 years ago, that was really the only source of private equity investment. And we've still retained most of those investors, had a very high recommitment rate. But today our funds come from all over the world. An increasing proportion come from private investors investing in platforms like Altaroc. But we have a mixture of large pension funds, state pension funds, sovereign wealth funds, private investors, corporate pension funds, insurance companies. We're probably 30%, 35, 40% US. Then the rough balance between Asia, Middle East, and
what is the average commitment?
It's probably around about the 50 million euro mark, but it's quite a range actually within that. So we have a small number of very large investors, and then a large number of quite small investors. But interestingly, the most important thing is to have a group of investors where you've got powerful knowledge on the ground as well that they can bring. So, working with you guys is fantastic because we can pick up the phone and you've got a lot of industrial knowledge and regional knowledge as well. That's extremely helpful to us.
What do you think differentiates Bridgepoint from other buyout managers?
Well, it's a number of things really, but first and foremost, it's a laser focus and total immersion in mid-market, in those companies growing up to $1 billion enterprise value. And you need a slightly different skill base, a different origination base, and a different value creation model in that area. And what we've done over 35 years is absolutely stuck to that area. Really know the sectors we're in, have deep industrial contacts. We're a major industrial player in some of the spaces in agri-tech or in medical aesthetics and so on. And that's immensely powerful for your origination. And I think when people look at Bridgepoint, obviously strong consistency of return, which you get in many funds, but it's quite rare to see the depth of resource we have on the platform at Bridgepoint directed at the middle market. And one of the, I think, interesting changes that's gone on is what we've done is instead of ending up with huge fund sizes, is to make sure that we have some different products directed at mid-market, and that gives us that total immersion. So we have 3 equity funds, credit funds and infra funds these days, and the interlink of that and the presence gives you the knowledge of what's going on, contacts, insights, relationships, powerful connections with all the advisors, and we're trying to compete unfairly. That's what we're trying to do, and I think we're reasonably successful at doing that.
Could you please elaborate on 2 to 3 of your latest buyout transactions, explain how you source them, and maybe zoom in on how you are creating value in those companies?
Typically, what we're doing is we match sector analysis and research with on-ground presence and that local insight. And across our sectors, which are those 3 sectors I mentioned earlier, healthcare, business services and advanced industrials, they're quite big. Those are actually quite big sort of silos, but we're into sort of certain niches where we have deep expertise. And our sector teams set out their thematic clearly to the investment committee every year. And it doesn't change dramatically, but it evolves in tilts. And what they do is say, well, within business services, these are the areas in a middle market context we don't want to be focused on. These are the areas we might be interested in looking at. And actually, this is the space, if we can find the right businesses, we'd really like to commit capital to. And obviously explain why we want to be in that space. And it's got big tailwinds, it's a new growth area, you haven't got large companies in that space yet, there's lots of consolidation and so on to be done. And the sector team will then work with the local offices to identify companies that fit that criteria. And so when we start a fund, we have a bunch of companies on the whiteboard, typically, not more than maybe 80, and we do 15 to 20 in a fund. And then we follow them for a long time. So it means that when we identify a company and we invest in it, we've probably been talking to them for 3 or 4 years. So we understand why we want to invest in it. We have a good view of what is the right price to pay for that investment. Actually, what is the price where we want to kind of not engage, what we're going to do with it, how we need to strengthen the team, who's likely to be an interested buyer, and so on later on. So in Fund 7, where Altaroc has its commitment today, If you take one example, in healthcare, we've been very active in medical aesthetics. Now, what is medical aesthetics? Well, it's sort of enhanced beauty care with a medical angle. And in our fifth fund, we had an investment in a company called HTL, which made pure hyaluronic acid. And hyaluronic acid is a natural substance which you produce in the body that gives lubrication to the skin. And in cosmetics, it's a substitute for Botox. And what's quite interesting in medical aesthetics is, I'm going to say you can probably tell by looking at me that I'm not looking so young, but there's a big market for people who want to look younger, and hyaluronic acid is a key ingredient to beauty products. And so through that investment in HTL, which is Europe's largest manufacturer of hyaluronic acid, we got to know the market extremely well. And this is high-end premium natural ingredients for cosmetics. And we did that with the family investment office of L'Oreal. So quite often we'll work with an industrial partner. And we successfully exited that company 2 or 3 years ago. And in building the knowledge that investment gave us, we decided that actually we should be trying to invest more in the space. And several of the customers of the company we felt were good targets to partner with. And we started a discussion with one of those companies, a business called Vivasi, which makes dermatological fillers, again, which are sort of injections that you put in to try and remove wrinkles. And interestingly, the attraction of that space is just one use of hyaluronic acid. The attraction of that space is that the customer base ranges from 22 to 80 probably, and it's a natural product that enhances people's looks, but it lasts for about 6 months. So you have a big repeat customer base, and of course, if you stop using it, you start to age quite quickly. So you have a very loyal customer base, and it's a global customer base. So it's based in Europe, big market in Asia, in the Middle East, and so on. So and it was one of the largest customers of HTL, our original investment. So we talked to the entrepreneur who owned the business, suggested we'd like to partner with him. It was a sort of 3-year conversation, and we eventually agreed a price that we felt made sense to both of us. We've got a lot of experience of working with entrepreneurs, and the attraction of the company was not only the things I've just said, but also just a lot that we felt we could do together, and that's involved the manufacturing footprint, taking it into new markets, looking at marketing, acquiring distributors, so a whole range of different things. So it's a good example of where we like to play. So good sector knowledge, lots of things we can do to the company to help it grow, and multiple levers that we can pull. So it's not just one route to creating value. And of course, when you look at that kind of business, it's our companies don't end their journey at the end of our 4 or 5 year investment period. They've still got a lot of growth left. So you can imagine a whole bunch of people wanting to own that kind of asset. It could be the large cosmetic groups, it could be another buyout group, could list. So our job is to return the capital to you in 100% of it, not a bunch of shares as well. So lots of opportunities to exit. A different sort of example would be our most recent investment, which is in the energy transition sector. In business services, we do a lot in energy transition. Again, we've got a lot of knowledge over 20 years. And in our infrastructure arm, it's a specialist energy transition, which gives us real depth of knowledge. And why is energy transition interesting? Well, we all debate climate change, but actually, whatever your views on climate change, the energy infrastructure of the world is aging, of the developed world is aging fast, and people are looking for more efficient energies and so on. And the technological development in that area is very, very fast. So people listening to this will be very familiar with the falling price of solar panels, for example. But one particularly interesting area is the wind market, where the size of turbines has grown dramatically over time, making it a much more efficient source of energy, and a source of energy that doesn't need government subsidies to compete with more traditional forms of energy. And we've invested a lot in the space. To date, we've avoided manufacturers of equipment because it's been quite a volatile sector, but our thematic has evolved, and as the sector has become profitable on a standalone basis without those subsidies, we've seen some really interesting opportunities to go into that kind of advanced manufacturing space. And Windar is one of the largest players in turbine towers, not the actual turbine fans, but the actual trunks of the turbine. And it specialises in very, very large towers for offshore use. And it has a competitive advantage given that these large towers are more difficult to transport from low-cost manufacturing areas like Korea, who are very good at producing turbines. Mainly because the turbines, if you have a large, you're getting into not too technical, but if you have a very large turbine on a boat and it starts to move around a bit, you can get hairline fractures in the tower. And obviously these are turbines that are going to be in the ground or in the sea for 30 or 40 years, so you just don't want to take that chance. So we partnered with the founders, bought out one of their shareholders, and this is a company that we acquired a stake at 8.5 times EBITDA. It's got a 4-year order book. There's a big waiting list for capacity. We're in the process of putting in more manufacturing capacity, expanding the geographic base, and so on, and increasing the technology. So. Lots of interesting things to do there as well.
And you mentioned 3 sectors. So you mentioned healthcare, advanced manufacturing, industrial, and business services. What about technology? Is it something that you consider as transversal, or how do you?
Yeah, I mean, technology runs through everything we do. So, yes, I mean, we're not a pure tech investor, but there's a heck of a lot of tech across everything we do. So, you can look at, you just go back to that company Windar, the technological design and the use of digital in that would be significant. The third investment we have in a fund is a business called MIQ, which is the global leader in programmatic advertising. Programmatic advertising is probably at the extreme end of the transition from to digital advertising, where I guess if you go back in time, we're all used to seeing billboards on the side of buildings or roads. Now, most effective advertising is the advertising you get on your mobile, where you happen to have been looking at Instagram or Twitter or X or something like that, and it's following what you're consuming yourself and then targeting advertising to you. And what MIQ does is it provides that data to, firstly to the 6 largest advertising agencies in the world, so you get very, very effective yields from your advertising spend, and then more broadly to the big brands so they can target where they spend their advertising dollars. And it's a really good example of it's not a tech company, but tech is absolutely the heart of what it does. And if you look across our portfolio, tech is at the heart of at least 50% of what we're doing. And that creates really, really interesting opportunities.
Moving on to the market environment, what is your perspective on the current environment? Is it a good time to invest?
I think we'll only know the answer to that in 4 years' time. That's the honest answer. But I think, you absolutely have to be alert to what's going on in the macro in our industry. That's my experience over 30 years. But each phase of the macro creates different opportunities. So the key is to not be complacent at all. I mean, that is the biggest, as I said earlier, the biggest risk in our industry. And to be constantly have that constructive anxiety to look at what are the market conditions today, how do you need to tack your strategy, and just because something's a good company, it doesn't mean it's a good investment. So you need to be very, very alert to pricing. You need to be alert to how secondary impacts from the macro come through into the portfolio. So when you look at the big shocks, it's not normally the big companies that get impacted, it's the companies down the line. And that is something to be alert to from a defensive perspective, but also from an offensive perspective. It can change where in a sector you want to be deploying capital. So I'd be pretty confident that the strategy of consistently committing capital while not trying to say, well, this is the next 6 months is going to be the most brilliant time to commit, is the right one to do in our space. And it's about, the way I think about this is that it's about relative outperformance. And what you've got to be very, very careful of is people saying, returns are going to come down, so we should be pricing our strategy lower. Very, very dangerous. If you keep in the front of your mind that on the average investor you want to be trying to hit 2.5 times plus money, now we know they won't all do that, some will do better, some will do worse, and you have that discipline, the fund as a whole will perform, and it'll outperform. Now, whether that outperformance is at 3 times money or becomes an amazing performance at 2 if the world has gone into a disaster, it doesn't really matter. It's going to outperform.
How do you see the private equity market evolve over the medium to long term?
Well, I think it's. I think you're going to see some very, very material change in our industry. And I don't think when you look at it, this is no different to most other industries. So what are the key ingredients for success? I think scale is becoming pretty important, and that is driven by the operating costs. So going back to the question you asked earlier, there is more competition around, there's more capital around, and therefore you need a well-resourced platform to deliver high quality returns. And unless you're going to just say, well, I'm going to be a mega buyout group and raise a 20 billion fund and compete with 15 others, if you're in a growth space, I think you end up our strategy has been to say, listen, we'll know our space really well, we'll have really high quality central resource, but we'll have other things on the platform as well, so you can share that resource and share that knowledge. And so I think you will see this industry consolidate, because the cost of doing business is much higher, and I think you'll see the emergence of really interesting platforms. And one of the big changes I've seen in the last decade is when we launched our lower mid-cap fund, Bridgepoint Development Capital, a lot of people said, we don't really, we like to pick our own funds in that space. And, we were talking recently and you were saying to me that now it's quite clear that those funds that are associated with the platforms have access to better returns, better resources, and that's clearly making a difference across returns. And I think that principle will operate across the industry. I don't believe that people will just come to Bridgepoint and do a Bridgepoint fund because it's Bridgepoint. That just isn't going to happen. People are very focused. And I think of your diligence program and the depth and the detail of the questions you guys asked. They will drill down into an individual fund, but I think the chances of you having a fund that is of much higher quality is significantly better if you're part of that bigger platform with better resources. And that I think is the way this world's going.
Thank you so much, William. We really appreciate you spending the time to talk to us about Bridgepoint and the private equity industry.
It's an absolute pleasure.